Welcome to the Moving Market Podcast. I'm JR Gondeck, as always, joined by David Sokolovsky. David, let's recap the month of May, right? The old sell in May and go away was not the case again this year.
Yeah, Jared. So May had very strong market performance and really across the board. If you look at any sector, you would have seen the prices go higher. You saw that the Nasdaq was up 8% in the month. The S&P 500 was up about 5% in the month of May. And again, that follows a 10% jump in April as well. So you now have markets, firmly at all-time highs across many of the different major market indices. And then as you look further across the market, really good performance across the board. Small cap was up 4.5% in the month and is up 18% year to date. International had another strong month, and if you look at emerging markets, that index is now up 25% on the year. I think it's a little bit misleading because if you strip out the largest component of that index and the best performing stock, the index is not obviously doing nearly as well, but still, overall international continues to do well. And then another interesting area is, as you look at the trends of growth and value and high dividend paying stocks, for the first part of this year, high dividend paying stocks were doing better than the S&P overall. And now you've seen the S&P actually overtake the high dividend paying stock category for the first time this year. And you're really seeing, growth continue to outperform or really start to outperform value for the first time. So the market continues to advance. It seems like momentum is firmly in place. And as we look ahead, what can we expect to see from the market?
Well, David, if you look at it, as you close the month of May, interesting data point where, as you mentioned, S&P 500 makes an all-time high, but only 20 stocks made an all-time high, which, according to Bank of America, is the first time since 1999 where you've had that type of trend. And what that tells you is a few companies are really driving a lot of the return, right? And that's memory chip, and a number of other areas within technology really moving up dramatically. And as we mentioned last month, the DRAM ETF, which was launched April 1st, is up 150% in 2 months. So you're seeing some concentration, some concern potentially. On the other hand, when you look at earnings season overall, it was strong across the board, right? So on one hand, you can be a little bit nervous that stock market and indices are at all-time highs. On the other hand, you take a step back, you look at earnings, you look at the economy, and there's good reason to justify where asset prices are for now, right? And as you look at, some trends ahead, you have some major IPOs coming, that could be somewhat of a potential drain on some of the liquidity in the markets, or to continue to fuel a lot of activity with the markets. And a couple of these are going to be, trillion plus dollar valuations likely. And again, the concern isn't normally the first IPO, because generally you sell 5 or 10% of the float of a company. So if it's $1 trillion valuation, it's 100 billion. The concern is more likely to be when they do secondary offerings, 6 to 9 months after the IPO, where that could, really suck up a lot of liquidity in the market. So it'll be something to watch for overall. But if we look at breakdown of GDP, David, it's pretty strong. The consumer continues to do well and continues to drive a lot of positive activity. And looking at, the predictions for second quarter GDP, we're solidly around 4%.
Andrew, so one of the things that we've talked about, and we brought up this statistic last year as well, is that the really infrastructure and data center has been responsible for a large component of GDP growth. But if you cast your eye down this chart, you look at the areas that have been the best performers. This is obviously going back to the fourth quarter of 2025, but you're seeing a lot of service activity. You're seeing wholesale trade, which really is the precursor to consumer spending. You see a lot of information technology, healthcare, and then real trade. So really a lot of goods and services kind of leading the way. Not seeing as much in data centers showing up in the economy yet, but ultimately as that spending continues, you know, as you look at markets, you want to invest in the areas where the economic activity actually is, because that's where the dollars are being spent, and ultimately the profitability for the companies. But look at where the largest drop off in spending has been. It's been the federal government. And so I think as government spending pulls back, it's going to be um, more challenging for industries to absorb a lot of that economic growth. And again, as the economy continues to expand, it's making sure that the growth is in the right places.
When as you turn to the month of June, we're gonna have a new Fed chairman taking his first meeting on June 17th. And you look at, again, the health of the overall economy, pretty solid. The labor market, continues to pick up, overall. And again, the Federal Reserve has said at this stage of economic growth, around 100,000 job growth is, pretty good. Whereas in normal economic periods, you usually want to see 200, 250,000. But again, we're very mature. And with all the AI, potential layoffs, those have been picked up overall. So, labor market continues to trend positively. Inflation with the war, you know, oil prices were down about 20% in the month of May. So we'll see if that headwind starts to level out a little bit. And again, with the Fed change, it's going to be interesting to see how the markets take. So we'd expect some volatility, in the month of June, and other areas to watch for because of the higher interest rates has been the housing market, right? The housing market, continues to be slower and slower overall. And in certain markets, you're seeing fire sales, where there's a lot of supply and prices being cut, in certain areas of the country, overall. So we'll see if, the housing market starts to benefit from all this extra gain within the stock market and you see some rebalancing back or not. And then as we look for, the rest of the year, the question is, as always, if you had $100, where are you investing it today, right? And I think it's a challenge overall. I think from the standpoint of seeing where asset prices are. On the other hand, like I said, taking a step back, looking at where the economy is, look where earnings are, there's still probably some decent opportunity, overall. And again, the breadth of the market, I think you got to have your exposure to momentum, in certain parts. But as always, I think you want to stay diversified and, kind of see where things go overall.
Yeah, Jared, I think with housing, as we talked about with Warsh being appointed, and I think you mentioned this in the last recording as well, one of his approaches is to, and one of the things he's looking to do is to reduce the size of the Federal Reserve balance sheet. And I think, as you pointed out in the past, it's about a $1 trillion reduction equates to about a half a percent interest rate cut. And so it'll be interesting to see because, as housing affordability remains high, housing prices are higher than, in most cases, than they have been. Obviously, as you've pointed out, there's been some discounting and some fire sales going on. But in general, I think across the economy, housing prices remain elevated, and combined with higher interest rates, it makes affordability that much harder. So as Warsh looks to reduce the balance sheet, one of the areas that's going to be reduced and where some additional liquidity is going to be needed is going to be in that commercial mortgage-backed security market. And so, that'll be, I think, a focus for the midterms, a focus for the administration ahead is to make housing more affordable. But the 30-year mortgage may no longer be the way to go. And we'll see if ARMs and other types of instruments become more interesting to lower that cost, right? As if you look at the 30-year mortgage rate, it's very high. If you look at some of the adjustable rate mortgages and some of the shorter duration mortgages, those rates move down very, very quickly. So.
When as you look to the rest of the year, I think I always like to remind investors, I mean, the two riskiest periods generally in investing are at the top of the market and the bottom of the market. Because if you overdo it at the bottom of the market, you're too conservative, as the markets turn, you can miss out. And the opposite could be true at the top of the market. If you chase, kind of that FOMO, fear of missing out, too much of the momentum or too many of the concentrated technology companies or areas that have done extremely well in the last couple of months, and that growth rate starts to slow at some point, there could be some, pretty big losses in the future. So I think, as always, you want to remain diversified. You can't be afraid to take some profit and pay some tax, periods like this to stay diversified because in some of these areas, you know, there have been substantial gains, and I think locking in some of those profits and still looking long term is going to be the best course of action as you navigate through these summer months. So with that, I want to thank you for tuning in, and we'll touch base next month.
Thank you.